Well, the good news for many of you who don't like Excel is that we're over the hump in terms of math and Excel work that we need to cover. Now we're back to just terms and concepts and theories. For many of you, that's not nearly as much fun. But let's take a look. Today we're going to talk about cash flows. An important topic in discussing cash flows is free cash flows. This is stuff like Warren Buffett looks at. Well, the first question we have to ask ourselves is, why do we look at after-tax cash flows and not profits? Don't we care about profits? Well, remember when we looked at income statements earlier on, income statements and profits include non-cash things. We care about the cash, but income statements include depreciation and amortization. So we really don't want to include those, but we are interested in the free cash flows that come from the operations. What we're interested in particular is incremental cash flows. If you recall what incremental means, it means the next little step, the next bit. Right? So if we do things in increments, meaning little steps, baby steps. Anyway, we don't care about things that happened in the past. If you had to invest some cash into a project, what happened in the past is done. Right? We don't care about that. It's this. Sunk costs are sunk. What happened in the past is done. It has nothing, no bearing on future decisions. Now, we can include things and effects from other projects. So if we start a new project and it happens to help maybe another product that we've got going and increases its revenue, that counts as incremental revenue. Right? If we come up with a new car and that helps us sell something else, a complementary good, then that's good. We can count that. We want to also not only include incremental revenues, but we want to look at incremental expenses as we go along. All right, and we're interested in free cash flows. As I said earlier, it's the cash from operations. We don't care about financial cash that's generated by selling bonds or selling stocks or selling assets. We care from operations in terms of cash flow. And that's the cash we're going to use to pay our bondholders or shareholders in terms of dividends. So we're separating this investment decision from the financing. We're going to look at our cash flows. That's the money that's coming in. Then we did the financing. We talked about in the last segments. How is the cost of financing incorporated? In the cost of capital. Right? Our cost of capital, K, is the discount factor we're going to use when we look at free cash flows. Now, we talked earlier when we talked about net present value of the initial outlay. Let's take a closer look at that. When we're looking at the initial outlay, we obviously have startup costs. We might have to build something. We might have to buy stuff, hire people. Right? So that would be increases in capital. Working capital, might have inventory we're building up. We might have cash on hand we might have to have. We might have money that we get from assets that we're selling. If we're going to upgrade our production line, we can sell our old production equipment or sell old buildings. That was money that comes in. We have to consider ourselves with taxes. If we sell an asset and it's gained in value, we're going to have to pay capital gains taxes. So all of these things need to get factored into the initial outlay. So it's the cost of new assets that we're buying minus the money that we get from selling the old junk, and we've got to take care of the tax implications. After we look at the initial outlay, now we've got to look at what happens on an annual basis. And this is where we're going to look at, I talked about earlier, the cash from operations. We have to adjust for depreciation, not just the depreciation, but the fact that the depreciation lowered our taxes. So that's going to be a little complication there, that our tax implication is not going to be the same if we didn't include depreciation. We don't count for interest expenses. That's not cash from operations. That's cash from financing. And then we're going to look at changes in net working capital. Did accounts receivable go up or down? Inventory up or down? Okay. So we're going to have to take a look at that in payables. So one way you can think of it, this is our operating income, right? Partly, it's going to not include interest. We have to adjust for taxes on depreciation, but it will account for potentially, actually it doesn't account for inventory changes in payables. So all those need to be modified in looking at the cash from operations on an annual basis. Then when the project ends, we're going to have a terminal value of the assets. This is going to be in practice a little tricky. You've got to figure out when you're going to count the project as ending. How long are you going to calculate out your present value? How many periods? And at the end of the period, you want to include the value of your assets there. So if you invested in some robots and stuff, are they worth anything at the end of that time or aren't they? If they are, you may have arbitrarily stopped at, say, 5-6 years. Well, if you do, your assets might have a value at that point. Even though you're going to continue to use them longer, you're going to include their terminal value in your calculations for the free cash flow. In the next segment, we're going to look at some of these things in practice and take a little bit more of a deeper look at the risk involved in this.